Welcome back to Lipper's Fund Flows Insight Report. I'm Jeff Tjornehoj. For the week ended October 24th, 2012, the conventional mutual funds industry, exclusive of exchange-traded funds, saw its flows dominated by taxable fixed income funds. This isn't a surprise given how much attention investors have had towards bond funds this year, but there were a lot of headwinds in the equity markets that kept investors on the sidelines as well. Not only is it earnings season and a lot of firms have been guiding estimates down, and as well as revenues in future quarters, but we've also got a presidential election on our hands that seems to be tighter than a lot of markets expected, and so naturally, with the markets not appreciating uncertainty very much, investors tended to stick with what they knew and stay on the sidelines. Let's take a look at our macro groups and see where the activity was. Starting off at the top, equity funds saw only $200 million in outflows this week. Taxable bond funds took in a solid $3.6 billion. Municipal debt funds, again, another good week for them, $576 million coming their way. And money market funds had outflows of $3.2 billion. Well, as I mentioned, presidential elections and a soft earnings season kept a lot of equity investors on the sidelines. This only applies to equity mutual funds. We'll talk about ETFs in a moment, but for now, $200 million in outflows this week follows a small amount of inflows last week. So at least the outflows are smaller, although there's still outflows for 10 out of the past 11 weeks. With only $200 million out this week, it's really a drop in the bucket, probably just a rounding error, in fact, given the size of this market. So investors are standing pat. They're not ready to commit one way or the other. We did see, however, a difference in their treatment of domestic versus non-domestic. For much of this year, American investors preferred domestic equities over their non-domestic counterparts. That reversed lately. This week was no exception. $800 million out of domestic funds, while non-domestic had inflows of about $600 million. Again, both those numbers are relatively small, being in the hundreds of millions of dollars. But at the margin, investors seem to be taking a liking to ex-US opportunities. Now let's look at what happened with equity ETFs. Their results were quite a bit different. Here we saw outflows of about $4.5 billion. We saw some inflow activity into MSCI Emerging Market ETF, which is under the ticker EEM. The FTSE China also had a decent week. However, at the losing end, SPY, the behemoth out there, had outflows of about $5.5 billion. And the Russell 2000K ETF, which is IWM, also had outflows near $1 billion. So some of the core ETF products that are domestically oriented face some of the sharpest outflows this week. So again, with some uncertainty in the air for American investors, it's little wonder then that they pulled money out of those areas and put them to work in opportunities outside the U.S. The next group we'll take a look at is taxable fixed income funds. Again, $3.6 billion, another solid showing for them. The 4-week moving average continues to stay above $3 billion, so they're definitely in a sweet spot right now. Products from DoubleLine, their total return fund, dominated the rankings this week for flows. We also saw short duration bond fund products from JPM and Lord Abbett also near the top of the chart. So overall, investors continue to be committed to fixed income. The variety is about the same as we've seen over the past few weeks. Now, if we turn our attention to fixed income ETFs, we see a slightly different pattern here. Inflows of about $784 million this week, a fairly decent showing after last week's $1.1 billion in inflows. So they're definitely also finding proving attractive to investors out there. Investment grade, mortgage-backed, and emerging market debt were all definitely in the top of investors' preferences this week, while we saw high yield funds and treasury ETFs suffer outflows. In fact, the ETF stalwart JNK had about $120 million in outflows this week. So investors are starting to feel that risk-off pressure and looking towards better opportunities, again, outside the U.S. For their exposure. Now, the next group to take a look at is municipal debt funds. They had a solid showing this week, $576 million in. General municipal debt funds led the way with about $111 million in inflows. High yield funds also did very well. They had over $100 million in inflows. Single state municipal debt funds had very little activity, most showing $0 exchange for them. So overall, investors continue to prefer those broad national munis as well as high yield for that extra income potential. Finally, let's take a look at money market funds. They had outflows of about $3.2 billion this week. Flows have been directionless for some time. We saw institutional investors remove about $1.7 billion from their accounts. Retail investors followed suit. They had about $1.5 billion in outflows. So neither group tending to find enough reason to keep money at work in cash. Maybe they're looking at some of those ex-US allocations and kind of ratcheting up their allocations thusly. So that's it for this week. Please join us again, same time, same place, for more funds analysis from Lipper, or join us at our website at www.lipperusfundflows.com for more up-to-date information. Thank you.